I will just start this session and then hand over the floor to Aurelio. So welcome back, everyone. We are moving into the first key session with respect to the separate entity approach. So far what we've seen is the M&E group approach and its interaction with the separate entity approach and what are the potential areas of tension. And then we saw Valerio's presentation, which gives us a lead into the entire transfer pricing dispute landscape, both at a prevention level and at a resolution level. Now, the objective of this session and the sessions to follow is to really look into what are the key areas of tension within the separate entity approach as applicable to certain transactions. And for this session, we are going to focus on intra-group services. And I have the pleasure to introduce the chair of the session, Aurelio Massimiano, who's a partner at Maisto Associati. And Aurelio, I hand over the floor to you, and you can introduce your co-panelists as well as tell everyone what is the session going to be all about. So thank you.
Thank you, Vikram, and thank you to the University of Lausanne for organizing this terrific conference. Our session will be divided into 4 different segments. We will start from the corporate view of main challenges for multinational enterprise. Then we will have a session on shareholder cost, audit, and MAP. The third session will be on Indian case studies. And finally, we will close, least but not last, with COVID-19 and intra-group services. For each segment, we will leave some time for making questions. So please, I invite the floor to make questions in the chat at the end of each presentation, so we can have some debate on the different topics. Now I would start immediately. I leave the floor to Vinat Raj, that is Vice President of Tax for Asia, Middle East, and Africa for Procter & Gamble.
Thank you, Aurelio. Thank you, University of Lausanne, Professor Denon, Professor Chan, for having me on this esteemed conference and on this esteemed panel. My name is Vinit Raj. I am the Asia, Middle East, Africa tax leader for Procter & Gamble. Given the region that I'm in, services is a very interesting topic and a challenging topic in this part of the world. So if you think about services, for us, from our point of view in our world, services are kind of broken into 5 different types. There's global, there is regional, what we call intra-cluster, that's really within a cluster of countries. And then there's the usual back office, and then there's transaction support and coordination. Why do we have this type of a setup? Well, essentially to leverage scale and efficiencies. Also to have enterprise-wide systems and processes which we can then adopt consistently across the region, across the globe. What's the issue today? There are several guidances available in different forms. The guidances today that exist are very broad and general, and they are not definitive enough, and that's what causes the challenges. I'm going to cover the challenges in 4 broad areas. So I'll cover deductibility, I'll cover withholding tax, I'll also cover some elements of the internal challenges. Deductibility and withholding tax are more from an external point of view, but internally as a company, I'll cover that. And the last part will be on certainty, rather uncertainty. So that's what I will focus on. So let's start with deductibility. The main element on deductibility is the benefit test and the cost of the benefit. Benefit test really is as a service recipient, what is the benefit that I have received from the service provider? And what's the cost for that benefit? So if you think about it, the taxpayer needs to go out and prove this is the benefit for that particular legal entity within the group structure where the service is provided. This is highly subjective evaluation. The documentation needed to prove this is onerous and is extensive. So much so that it actually gets into cost center level details. That's the kind of request that we've been seeing from the authorities. Some authorities are even kind of asking for timesheet, the accounting firm, the law firm timesheet type of data in order to support the benefit. The other issue linked to this is, what's the right price for this benefit? Is the cost that is charged for this benefit commensurate with the benefit? Could I have done it cheaper if I did it myself? Look, the reality is that the cost is already incurred. The reality is that there is a cost in a cost reduction environment, in a headcount freeze environment, there is a cost that is already incurred. Somewhere in some form, the deductibility has to come by, unless it is explicitly disallowed within the local regulation. So that's kind of one of the challenges that we face. It's almost certain that whatever is the charge, it is very unlikely that the entire amount is going to be allowed as a deduction unchallenged. Let me move to the second aspect, withholding tax. Given that on the deductibility side, there is a lot of discussion and debate that goes on at the audit and appeal and tribunal levels, and even at court levels, some regulators, some jurisdictions have taken the view to just take it as withholding tax. Withholding tax is easy, it's time efficient, and it actually ends up delivering a better dollar to the tax authorities. Why? Because typically withholding tax is on the total fee and not just on the service element that we are talking about. So oftentimes withholding tax ends up being higher than actually the service fee, and that's kind of interesting. Some jurisdictions have actually taken the view on both sides, and they're not only just challenging the deductibility, but also going after the withholding tax. So it's both. At the recipient level, given the high amount of withholding tax, can you even claim the entire amount as a credit? Or is there a tax leakage? Or is there a double taxation that's happening? So that's on the withholding tax. But one of the challenges on withholding tax really is the characterization of the service. Is the service really intangible? Or is it really in the nature of service? And if it is in the nature of service, is it provided outside of the country? And should there even be a withholding tax? More often than not, regulations may exempt withholding tax on that. And that's why the regulations or the authorities try to go after the intangible route, because that's where there is some sort of a collection possible. So when you think about withholding tax, it again is an area where it's going to lead into multiple taxation, and there is going to be tax leakage. Let me focus on the internal side. So on the internal side, and this kind of links back to the benefit test, there is a tendency for people involved in providing the services to kind of glamorize the work that they're doing. So really the work inside might be something, but the positioning of the work could be different. And this makes it hard from an internal point of view to ascertain which bucket should it fall into, right? So this glamorization of service, and with LinkedIn profiles of people reflecting many different descriptions, can become quite interesting, especially with the authorities now having access to various data points. In addition to this, from an internal point of view, determining the pool size. So what's really the pool? How do you get to the pool? Allocation is one part, but really what's the components that go into the pool is another challenging area. It's highly time, resource, systems intensive to get to a a right kind of order or a reasonable kind of pot, which then gets allocated. And it starts to become interesting when it's not a service entity by itself, but it's some roles within a particular entity which are providing the service element. And it gets even more interesting when the roles have a dual job. So one which might be a bit more global, regional, and the other might be country specific. So these are kind of the dynamics that need to that go in developing what the pool really is. But at the end of the day, the cost is already incurred. If the cost is already incurred, deductibility needs to happen somewhere. And that kind of goes to my last point, which is there is no mechanism for certainty on this uncertainty. So the regulations are broad, the regulations are not definitive. At the same time, there isn't really a mechanism globally where you can get the certainty. So I think from a taxpayer's point of view, there is a challenge. When you look at markets which are exchange control driven, there is also a challenge in taking the money out from those countries. So if one puts all this together, an MNE then starts making a choice, whether does it even want to charge the right share to the entity who is a recipient of the service. And it could lead to a different outcome. What I also think that principal structures are a bit better. Centralized structures are a bit better because then you're isolating the issue to some of the markets versus all the markets. And I think from an MNE point of view, the challenges are significant. As MNEs operate at a global level, services will continue to be there. And I think the challenges will continue to be there till such time that there is some kind of a definitive possibility for resolution.
Thank you, Vinit. I especially like very much what you said in the beginning. So the experience in tax audit is that tax authorities also like to ask for very detailed information like timesheets or so that very often in corporates are generally not available. Now, what my experience also in tax audits is that the first assumption of tax authorities is that, well, there has been no service been provided or no benefit has been received at all. And very often when I discuss then with people in these groups, it may very well be that on the recipient side, it is really not so visible what exactly is happening centrally, and yet it may provide a significant benefit. So very often what I find helpful in tax audits, and I would be very interested in your view on this, is, I mean, in a lot of instances when central services are being provided, certain physical outputs are being prepared. For example, market report presentation, there may be meeting minutes around, et cetera, et cetera. Now, of course, the question is how much effort can you put into categorizing these, filing these, and so on, so that you are prepared for a tax audit discussion. And yet a lot of groups that I have been talking to also found it, from what you mentioned in terms of internal challenges, perhaps really helpful, so that there may be group companies around that get a lot of charges for services where they don't, from their perspective, really see the benefit, and such a collection of, hey, what do we actually do? How does our service output actually benefit your business? Was actually also helpful from an internal perspective in increasing the acceptance of such charges from an internal perspective. But I would be interested in your perspective on whether you do such collections of physical service outputs, or what were your audit experiences in that respect?
No, Gerard, it's a great question, and thank you for building up on the points that I was talking about. When I think about the output, and as I was thinking through about our session today, The thought that was crossing my mind is, how does one go out and demonstrate a toolkit which is developed for an ad campaign centrally? How does one value that? How does one kind of determine what's the benefit to the recipient entity on the ground? It's really a struggle. But what we do internally is we have great systems to collect every kind of interaction that happens centrally. Well, not every, but several kinds of interactions that happen. There is a whole list. There are some regulations that have defined what kind of documentation are needed. If you go through for example, of all the countries, New Zealand tax authority's website actually has a list of things that you could consider. Some of our audit experiences have defined this. Internally, we call this as Project TAP, or Tax Audit Preparedness Program. It's really an attempt to collect upfront standard type of information, which are typically asked by the authorities based on our experiences. And then you create a repository in some kind of a SharePoint. And that's then tapped into. More often than not, there is also a view of several authorities that you're a big MNC, so you should be able to give me information in 20 minutes of me asking you. And that kind of becomes a challenge. Never ever have we been able to meet a 20-minute timeline, but there is always a expectation to kind of turn it around really fast. And based on our experiences, whatever is standard, we are putting it together. If there are follow-ups and non-standards, then we have to take it as it comes.
Thank you, Vinat. I don't know, Gerard, if you have additional comments. Otherwise, we can take some questions that are arriving from the floor. I start with the first one. Is payment of IGS charge justified when the payer entity, service recipient, is consistently incurring losses? So I can start, but of course I ask also my co-panelists to comment. The issue here is that, let's say, the losses in itself should not be a reason for not getting a deduction of intra-group services. Then, of course, there is a different issue that it's not related to the provision of services, is up to when in a multinational group there is an interest to have a subsidiary that is always incurring losses. So we know that on this, the OECD guidelines indicates that third parties at some point, when there is a recurring loss, could decide to shut down the business. And so if it does not happen within a multinational group, it could be that there is a different interest. So for example, because a multinational group want to be present in a market, even if they are making losses. And so at that point, it's not a question of intra-group services, but it's a question of the need to have a support to the subsidiary to the extent that, let's say, the subsidiary is never making profit, and so it means that there is an interest of the group to be present in the specific market. I don't know if someone else of the panel, from the panel, want to comment on that question.
Aurelio, I am very much in the same position as you. At the end of the day, just because an entity has losses doesn't mean that it doesn't have services. I think the root cause of what's causing the losses needs to be understood. Is the losses occurring because there is some kind of strategy in terms of new product introductions or new channels of business, or reacting to competition activities? What's the real driver of the losses? I think that needs to be understood. But also at the same time, what's relevant is to understand, is the entity in a structural issue? If the entity is in a structural issue, then the discussion would be very, very different. And this is where centralized versus decentralized model and the fact pattern comes into being for an assessment. That I think is a very powerful way of looking at it before concluding that just because there is a loss, it should not have a charge.
And I would take a minute also, let's say, an additional question that is on the issue you are just mentioning. Indeed, there is a question asking, saying, interesting comment regarding centralized structures. Here advisors recommending a move away from principal models. Could you just revisit your view once more?
Look, at the end of the day, it goes back to what's the fundamental of business. How does business want to run their operations? If the business wants to make sure to have global reach, global perspective, if the business is looking to continue with the regional synergies that it has, as well as react to competition faster from a region point of view, that works. So I think it really goes back to the fact pattern. It's not easy to run a centralized model. It takes a lot of time, effort, energy. It takes a lot of activity support system behind that. Not just about tax or the other aspect. Just because you're setting up in a central location, it just has its issues of its own. So not everybody can run it as straightforward or as smoothly. But I think it goes back to the business fact pattern. If business is wanting to run it that way, then only then the outcome tax can support it, not otherwise.
Okay. Okay, I would take just a last question, then we can move to the next topic. I see that there are also other questions that we can address at a later stage. But one question is, has country-by-country reporting Action 13 already played a role in audit or in MAP so far? Are there any experience in this regard? So experience on audit that were driven from information get by tax authorities through the country-by-country reporting. Rinat, I don't know if you have any experience on these, but I, of course, ask also the other panelists.
Yeah, from my experience, I've not seen a link in the audit with the country-by-country report as yet, at least in the markets that I'm having operations on and the ones that I'm responsible for. I've not seen there a direct link. There have been occasional instances where one or two items of clarification has been sought in terms of certain expense item, but not beyond that. It's not really used in the audit or in the assessment. And I guess it's also because the basis of country by country, the gap numbers are very different versus what you see in the local financial statements. So we've not been asked to reconcile as well in our experience. Everybody understands, I think, that country by country report is mainly to give a high level risk assessment, but not deep dive. And for the deep dive, they're going back to the local financial statements and the fact patterns.
We have actually seen cases where where the information contained in the country by country reporting has been used in the audit to ask like relatively detailed follow-up questions then. And these were then cases where, okay, we had a service provider outside of Switzerland, and the basic question was, well, is this really a service that is being provided that can just be paid cost plus, or is the fact pattern actually in a way that we should allocate portion of the residual profit to this seemingly service provider? There were quite good questions then asked in the audit outside of Switzerland that were based around the question, okay, what are the main activities of those companies? How much profit do they make, and how many people do they have on the payroll?
Yeah, I would just add final comment that it's also the fact that tax authorities take a while before processing the information. So let's say probably we will see an increasing use of country-by-country reporting in the coming years. Now, let's say most of the country has just received last year the first set of information, and so it will take a while before there is always a gap from the moment in which information are received and risk assessment procedures are ready and audit are started. So I would expect also a time gap and so an increasing use in the coming years. I would now move at this point to the second topic, and it's shareholder cost and MAP. I ask Camille Villaseca, that it's Research Associate at the Tax Policy Center of the University of Lausanne, to start, and at the end I will add a few comments on the experience on audit and competent authorities procedures on intra-group services.
Yeah, thank you. So good morning, everyone. I'm Camille Villaseca. I'm currently a PhD candidate supervised by Professor Chand at the University of Lausanne. And as Aurelio was saying, today I will do a presentation on shareholders' activities and shareholder costs. So first of all, when you are a taxpayer and you are analyzing your intra-group services for transfer pricing purposes, the first step is you have to determine whether the service has been effectively rendered or not. And to this end, you need to apply the benefit test. However, it may happen that in some situations, you need to make further analysis. It can happen that you have some activities that are rendered in relation with several group members or for the group as a whole. And in some specific cases, under comparable facts and circumstances, it would be an activity that an independent party would not have been willing to pay for or to perform for itself. In this case, the activity could be a shareholder activity. Then, in order to determine whether these activities are intra-group services or shareholder activities, it must be asserted if they were performed by a group member. Usually, it would be the parent company or a regional holding company, solely in its capacity as shareholder, and more generally because of its ownership interest in one or more other group members. If the answer is positive, the activities would qualify as shareholder activities. In order to reach this conclusion, the taxpayer can also ask himself the following questions. For example, is the activity benefiting the whole group? Or does it benefit the parent company only? Should it be allocated out to the subsidiaries, or should it be considered to benefit to a certain subsidiary? Next slide. So once you have reached the conclusion that you have a shareholder activity, it means that it's not an intra-group service, and thus it means that it's not chargeable. So it means that the person that received the activity is not supposed to remunerate the parent company or the regional holding company. Next slide, please. So here on this slide, I've put you a few examples that were actually provided by the OECD in the transfer pricing guidelines in the 2017 version, and it represents costs that you can assume are shareholder costs. So the first one would be costs relating to the juridical structure of the parent company itself, then costs relating to reporting requirements of the parent company, then costs of raising funds for the acquisition of its participations, and costs relating to the parent company's investor relations, then costs relating to compliance of the parent company with the relevant tax laws, and finally costs which are ancillary to the corporate governance of the MNE as a whole. Just to give you a practical example of that, let's assume that you have a parent company, and under the laws of its state of incorporation, it is required to prepare and file periodic reports that reflect financial data from the operations of the whole group. And this parent company has subsidiaries all around the world, and they all have their separate accounting departments, so it means that they do prepare themselves their financial statements. Once they're done preparing their financial statements, they send it to the parent company, and then the parent company analyzes and compiles this financial data in the legally required reports. It then forwards the report to the competent authority. Here, in this case, because the parent company preparation and filling of the reports relate solely to its role as a shareholder in the subsidiaries and to its compliance with reporting, legal or regulatory requirements, the activities would be shareholder activities, and therefore it means that the subsidiaries are not considered to obtain a benefit from the preparation and the filling of this report. It also means that the subsidiaries should not remunerate the parent company for these activities. Next slide, please. So shareholders' activities bring challenges to the MNEs. The first challenge that I would like to highlight is actually about the definition of the activities of shareholders. So here it's actually quite complex to determine whether you have an intra-group services or a shareholder activities. And the OECD invited public comments on the future revision of the intra-group services section of the transfer pricing guidelines. And it was actually highlighted several times that the definition contained in the TPG was unclear and vague, and that more examples should be provided in order to avoid, for example, the complex task of analyzing borderline cases. So you have cases where it's actually very complex to determine whether it is a shareholder activity or not. And sometimes you also have cases where, for example, if the parent entity performs an activity related to other group members solely for its benefits, here it would be a shareholder activity, it's clear, but along with this activity, it might provide an additional service to the group members. And this additional service would not only benefit the parent company, but also the members. So here the taxpayer has to figure out whether an additional service has been rendered or not. A practical example of that would be costs of the parent company's audit of the accounts of the subsidiary. If it is carried out exclusively in the interest of the parent, then the costs would be derived from a shareholder activity. Here it's clear. Nonetheless, if we assume that the audit is also in the interest of the subsidiaries, for example, because the audit is mandatory under the laws of the state of incorporation of the subsidiary, well, here an additional service might be rendered, and you have to determine whether the benefit test is passed for this additional service. So all those borderline cases and the cases where possibly you have an additional service will always depend on facts and circumstances surrounding the case. So it can possibly lead to tensions and to audit controversy, where you have, for example, the MNE that deems an activity as a shareholder activity, but the tax administrations view the same activity as being an intra-group service or partly as an intra-group services, and vice versa. Then you also have the issue of differentiation with stewardship activities. This concept was actually introduced in the transfer pricing guidelines in the 1979 version, and it covers a wider range of activities that are performed by a shareholder that may include the provision of services to other group members, as for example, services that would be provided by a coordinating center. So here you see stewardship activities is actually a very broad term where you will have shareholder activities that are non-chargeable, and it also includes some provision of services that should be chargeable. So here, in my opinion, the OECD should simply delete this concept from the transfer pricing guidelines because it's a confusing concept, and we should stick to the shareholder activity non-chargeable and intra-group services chargeable. And now I will give you the floor to my colleague Aurelio to talk about MAP and audit. Thank you. You're on mute, Aurelio.
Thank you very much, Camille. Just very quick comments on which is our experience in the context of audit and intra-group and competent authority procedures on intra-group services. So, as we all know, the possible tax authority claims could be first point on the existence of a services, and the second point on the charge, on the price, the markup, if we are in a cost plus context. Which is the most challenging issue? I would say the first one, and as was also indicated by Inet on the base of his experience. We basically on the first part on the existence of services, we have a number of issues because from one side it is necessary to prove that the services has been rendered. So proving an activity after numbers of years, it's not very straightforward. Audit arrives 3, 4, 5 years later after the moment in which there was the provision of services. People can change, and in addition, as again was illustrated by Vinet, in an intra-group contest, relations are quite formal. You don't ask for a written opinion from your colleagues in headquarters. Normally, it's frequent to have a call, now video call, or discussing chat and so on. So, on the base of our experience, it is extremely difficult, and would be recommended to prepare year by year a file for justifying the existence of the services without waiting for an audit starting. The second point, assuming that the multinational companies is able to prove that the services was rendered, as was illustrated by Camille, it's the benefit test. And let's say we know that this is a gray area because it's not always so straightforward to understand, as in the example of audit, if an activity is done or not for the benefit of the parent company or for the benefit of the subsidiary. So I would say that normally the discussion on the markup, it's something arriving at the later stage. To some extent, it's the one that it's less critical, because of course then you can discuss about comparable and so on. But the most challenging part is the first one. And this could have a ramification also on competent authority procedures. Why? Because let's say it happens, this is something, for example, quite common in Italy, but we have seen also other jurisdictions that have this issue, that if the challenge is on the existence of the cost, and so it is not raised on the base of the internal transfer pricing rule or on the base of Article 9 of the tax treaty, there are some tax authorities that can not grant the access to a competent authority procedure, saying that, no, look, this is not a transfer pricing issue because basically you have not demonstrated the existence of an activity, the existence of a services. Now, while under tax treaty and arbitration convention, there are not specific remedy in case state does not grant the access to the mutual agreement procedure, we have instead now an important tool under the dispute resolution directive. Indeed, let's say in case of denial, the taxpayer can, from one of the two tax authorities, the taxpayer can file a complaint to the advisory commission to demonstrate that, let's say, also the issue of the existence of the services, it's under the umbrella of Article 9, and therefore the issue should be discussed between competent authorities. I stop here. I don't know if my co-panelists, probably there is Sima and Vinnet that want to make additional comments, and then we can take some questions from the floor.
Aurelio, for me, Camille and you have covered it quite comprehensively. The one add that I would have is the practical handling of the definition between authorities. So you would have different authorities taking different view on what is shareholder cost and what is a service, and you could get into a mismatch situation over there, and that becomes interesting at a practical level. That's the watch out, or that's an experience that I just want to put it out there.
Thank you, Sima. I'm asking Sima, do you want to make any additional comment?
No, absolutely. I agree with what Vineet had to say. Just in terms of, the definition of, just to give an example to further what Vineet was saying, if you look at the definition of low value services as defined in the OECD versus in the Indian regulations, for example, there are certain services like back office services which have clearly been excluded from the definition of low value services, which are eligible for the cost plus 5% markup. So these kind of inconsistencies in adoption of definitions, it'll be really interesting to see how these pan out in MAP proceedings.
Thank you very much, Sima. Okay, I would now take some questions from the floor. Start with the first one that is for Camilla. Staying with the differentiation between shareholder and stewardship. Stewardship was deleted in the 1995 transfer pricing guidelines. There is an anomaly because the model convention refers to a carve out for stewardship services from the definition of P. Is there a need for stewardship services to be replaced by shareholder services for P carve out also?
That's actually a very good question that I would have to think about. I don't know if already you have an answer in mind.
But let's say if of course it's not straightforward the answer, but the immediate reaction is yes. I think that let's say if there is the assumption that basically there is an overlap between the two concepts, probably could make sense to have this change. Probably in the context of a profit attribution, it's more appropriate to use the word stewardship instead of shareholder, not being the head office, the shareholder, being the same legal entity. So probably this is the reason why there is still this distinction in the transfer pricing guidelines and in the model convention. Take also an additional question that it's on cross-border move of employees. So the question is, would you like ask if during an audit the cross-border move of employees could be seen as a service from tax authority, and if a remuneration could be claimed? So depends on what we mean with a cross-border move of employees, because if we have in mind secondment should not be a service. So if I'm just seconding an employee to another seat, let's say, should not be a service, and normally there is just a recharge of the cost of the employee. It's a different situation where, let's say, there is a team that is working for a subsidiary with a specific project, and they move to the subsidiary for this specific project. In that case, let's say, we are probably more in the concept of service than secondment. So let's say it's something that should be seen case by case, but normally, at least on the base of my experience, but I ask also the other panelists to comment if they have different experience. Let's say the issue of services is more when there is a team, so more than one employees that have to provide a specific activity with a specific responsibility.
Aurelio, I would add one comment here, and which is what I would also consider in making the evaluation, in addition to exactly what you said, is what's the activity scope? Is the scope of the activity for the entity where the secondment is being done or where the employee is being sent? Or is the scope of the activity of the entity whose employee is being sent? I think that would become relevant to ascertain whether is it really a secondment or whether it is a service provision. And is it a service provision because, for example, if there is a plant being set up, and if you're sending somebody on secondment as an engineering person to oversee the plant setup, the question is that an engineering service, or is the arrangement a secondment arrangement? I think, and I know it's not probably too relevant in this context, but I think what will also be relevant is immigration issues, as well as personal tax consequences on arrangement like these, which probably might even drive the answer in a certain direction.
Thank you, Wina. I would take a last question before moving to the next segment, that it's on the experience with APA for services. Are such experiences different from those in course of tax audit, and why? And then if there are differences, we reference to outbound provision of services from inbound receipt of services. I can start with the Italian view. I would say that APA on services, it's something we are strongly in favor, but in general, for a number of reasons. The first reason, it's the time. So normally APA it's for the future, and you have not to, as I said, go back to 3-4 years back to gather evidences on the services that were rendered. In the context of APA, normally, let's say there are also different ways to prove the existence of a services and the existence of a benefit. Indeed, let's say normally during the due diligence phase in APA, there are very often interviews with managers. This could not be available under audits, but if people after 3, 4, 5 years are out of the company. So let's say, I would say on the base of the experience we have in Italy, that APA for services is something that, let's say, works very well, and personally have strong preference about when, of course, intra-group services are relevant to have a discussion in an APA contest than an audit contest. I don't know if there is any additional comment on this question, otherwise we can move to the next session. Okay, so I would now leave the floor to Sima Keriwal, that is a partner of BMR Legal India, that will discuss about Indian case law on intra-group services.
Hi everyone, I'm Seema. I'm a partner in the transfer pricing practice of BMR Legal. Transfer pricing was introduced in India in 2001. I've pretty much been doing it ever since.
I think that we have a problem with the connection. We can wait a while. I don't know if it's only me. I ask my co-panelists if they have the same problem.
Yes. I think it's Seema.
Yeah, it's Seema. So let's say, let's wait a few seconds. Otherwise, I would ask Gerard to start with his section on impact of COVID-19 on intra-group services, and then we can go back to Indian case study as soon as Seema is back with the connection. So Gerard, if it is fine for you, we can move, change the order and discuss about COVID-19 and intra-group services, and then as soon as Seema is able to connect, we can have the session on case law.
Sure, sure. Thank you very much. Yeah, COVID-19. So as a looking at my discussions currently, I think it is fair to say that there is no business whatsoever that has left untouched by COVID-19 and its impact on business. And therefore, not surprisingly, one of the questions that I get most asked in the past months and also at the moment is, well, do I really need to pay to my service providers in the group a profit as high as in the past years when at the same time the rest of the group has the most horrible financial year ever? And I think the answer, as almost always in transfer pricing, is it depends. And because it depends, I think we should explore on what it exactly depends and how we can narrow down an answer to the question as to what COVID-19 may mean actually for service providers. So the first question in my view is, well, is there at all the possibility to reduce the remuneration for a service provider so that they show a lower profitability compared to prior years, or that they even make losses? And the most important aspect to look at this is the risk profile of the service provider, of course. Now, I think there is widespread consensus that COVID by itself should not per se change the allocation of the risks in a service arrangement. However, looking as to what is happening, I think it's also fair to say that the pandemic has led to a pronounced materialization of certain risks that we haven't seen in the past, especially risks related, for example, to the market demand. And it also brought to light a lot of risks that few groups may have thought before. So, I mean, if you asked around like 2-3 years ago, how probable would you think it is that governments would shut down whole industries several times per year for several months? I think most people would have said that this is not a risk that they specifically think about when setting up their intra-group arrangements. So a starting point for the analysis as to who should bear the risks that now have materialized could be the contractual arrangement between the parties. But in my experience, as I said, the past year has also shown a lot of situations that probably are not explicitly dealt with in intra-group agreements, and where there is also within groups not a standard procedure of how to deal with that. So, for example, the question as to, well, how often have you seen in intra-group context the question as to whether one should call on the first force majeure clause, or how force majeure is governed in the relevant laws of the country? That was something that I think was a quite specific case that did not arise frequently in the past. And therefore, I think it is most important that companies need to evaluate the options realistically available to them, which is also what independent companies would generally do. And I think there is widespread evidence from the press, but also available within groups, that independent parties may find themselves in situations where they do not necessarily want to enforce all their contractual rights, because long-term that may put them in a worse financial situation than if they are more accommodating and renegotiating agreements. So, for example, one of my clients, it's a clothing group that sells clothes, and among others, they also sell these clothes via third-party sales agents. And this group came to the conclusion that they are actually better off by paying subsidies to some of their independent sales agents, so between third parties, although there was no contractual obligations to pay such subsidies. But they came to the conclusion that such payments would still commercially make sense for them, rather than after the crisis being left with a significant part of their sales channel disappearing because these sales agents would go insolvent. And of course, if you have within your group such examples available, I think that is also a very good starting point to evaluate how you could deal with your intra-group agreements. Now, finally, on that point, what is the OECD position on losses? Now, the OECD recognizes in various parts of the OECD guidelines that related parties can make losses, but it is also said that routine companies are, of course, not expected to have ongoing losses. And I mean, I think in reverse, one can conclude from that short-term losses, even in routine companies, are not per se excluded. So I think sometimes I'm confronted in tax audits with a clear demand of tax authorities that if we have a routine company, whatever happens in the world, they need to make a profit. I think for that position per se, there is not there is no support in the OECD guidelines, but that requires further analysis. Now then, on the next slide, if you have come to the conclusion that you actually can adjust your remuneration or renegotiate the contractual arrangement, the question then, of course, comes up, well, what does that mean? Can they now make a loss, or what should the profitability or the remuneration of your service provider actually be? That question will largely center around possibilities to approximate prices that are agreed between independent parties during 2020, and now looking as to how the situation globally evolves, probably also in 21. And I think that approximation is not so easy, given that we have a time lag in the availability of reasonable financial data in databases. Now, what to do with that? So one possibility that has been frequently discussed in articles, blog articles and literature in the past months is the analysis of how profitability has developed in past crises, for example, the financial crisis. Now, the OECD in the specific COVID guidance that has been released shortly before Christmas has raised quite significant concerns around an unreflected use of such an approach. And I think to some extent rightfully so, because the COVID crisis has hit different groups in very different manners. So some companies have been hit very hard, also long term. Others were hard hit, but they had a very quick recovery, etc., etc. So there is a very diverse profitability or development profile across industry. However, I think as there is often a lack of clear other data points, I still find it valuable for groups to consider data from previous crises, and one may well come to the conclusion that depending on the specific circumstances, companies were hit in a similar manner by prior crises, and that would at least give some first indications as to how the current crisis could be also handled from a transfer pricing perspective. Now, depending on the individual circumstances, there may still be potentially comparable situations with third-party service providers within groups. So one of my clients, for example, has an internal logistics service provider that operates a warehouse, but at the same time, they also have two third-party logistics service providers. And these third-party logistics service providers had renegotiated their contracts, and the result of that renegotiation was a revised pricing model with a higher base fee to partially make up for the loss in turnover volume in these warehouses. And I think the fact that companies then in such a third-party situation agree to such a contract revision may potentially be really a good starting point to analyze a similar revision in your intra-group transaction. On the other hand, of course, I think it's clear that that most groups will not be in the comfortable situation to directly have such internal comparables at hand, and therefore I think it's extremely important that companies just gather whatever evidence is around, and also try to narrow down the right prices by choosing more than one option or more than one approach, because probably one single approach will not provide by itself a technically really convincing solution in all cases. On the last slide, I have just put together a couple of further considerations. So, I mean, if the remuneration has been determined, the question is, how do we implement this? And looking at the fact that 2021 also is not just a normal year, I think it is reasonable to not wait until December and then shoot in a very large year-end adjustment in the P&L, but to think about revised pricing early on and also implement that throughout the year. And what in my view is perhaps even more important is, I mean, what Aurelio has said earlier, I mean, documenting services and documenting considerations years after the fact happened is always a very difficult one. So therefore, especially in these exceptional circumstances, I think it's extremely important to early on put together good documentation around what the considerations were, which evidence has been used, and what the calculations were that have actually been done, rather than doing something ad hoc and relying on that in 3 years' time in a tax audit, one can put together good documentation. And as a last point, I think such an exceptional situation may also always be a good trigger point for reviewing the overall TP method or the TP model and evaluate whether all the relevant points are considered there. I think the last year has clearly shown that things that 2-3 years ago have been considered as being irrelevant and not being dealt with in transfer pricing are actually not so irrelevant, and perhaps need to be dealt with specifically, so that for the future one is better prepared than one has been for the past. And with that, I think I would like to hand over to Aurelio for perhaps some additional thoughts on this.
Yes, thank you, Gerard, for the excellent presentation. While we speak, I see that OECD has just published an update guidance on tax treaty and the impact of COVID-19 pandemic. But let's say it's more focused on the tax treaties issue, so PE, residents and of individual residents of company and so on. So it seems that there are no additional indication on transfer pricing. I have just a quite provocative question. I will also try to give an answer that I was discussing with the clients a few days ago. The question is the following: looking at Intra Group Services, there were some services that are within the low value added services, but during the pandemic they have been crucial. I make an example: IT. It's in the list of low value added services, of course, to the extent that the activity of the company, it's the IT, it's not the core activity of the company. But let's say during the pandemic, IT has been crucial because they have to arrange the system for video call, for having people working from home, and so on. And so the question was, are we sure that is still a low value added services considering the context? My answer is yes, it is still a low value added services because low value added services means that they are not, it's not the core activity, does not mean that it's not essential. Also, when I'm in the office, without the IT infrastructure, I will not be able to work. Probably it's different if, but I don't think that we are in that case in the IT, for companies that have to make changes in the business model. So think about retails, the implementation of an IT infrastructure for starting an e-commerce activity. But probably this activity is out of scope of low value services in any case, and normally it's more outsourced. So I don't know how you see this point, Gerard, if you share my thoughts.
I think I generally share your thought. Perhaps it's also like when I discuss with clients, I think the fact that we call low value adding services low value adding does not always help the discussion when you talk to somebody who is governing the IT service department of a company, because it sounds like it's unimportant or something like this. And I think exactly what you say, the fact that something is being called low value adding doesn't mean that it's irrelevant or that it's not important for the company. But I think especially in the IT service space, I mean, one of the questions is also, could I outsource part of this? And yes, probably you could outsource that. And yeah, it may well be that the prices have gone up for certain things in the past year because demand and supply were different than in past years. But I think in general, it doesn't change the fact that it's a low value adding support service.
Yeah, thank you. Thank you, Gerard. Let's say I would grab some questions before I see that Sima is back. So let me take just one question from the floor for Gerard, and then we can move to the last section on case law. As OECD guidance on COVID, it's leaving room for interpretation. Let me ask your opinion on whether a contract manufacturer who has a limited profile can be in a loss position due to the demand decrease and not follow the standard TP policy of cost plus 5%, for instance.
Well, I think they are, well, it depends, of course, is the answer. But I think I would want to take that into two different aspects. One is the question, why has the volume gone down? And I think limited risk does not necessarily mean no risk. I mean, if your government shuts down your factory, we may also need to look at the question as to, well, is this then something that is not in the original sphere of the contract manufacturer, or is this really a risk that is borne by the principal? So therefore, I think the question is a little bit, where does this decrease in demand come from? The second question is, where does the cost plus 5 come from? And is 5% profit still the right answer? Because typically we say, well, the cost plus 5 is right because comparable companies earn this amount of profit in similar transactions or in comparable transactions. Now the question is, have comparable companies in comparable transactions earned 5% also in 2020, which is something for which no database data points are yet available. that we will need to see, but I could well imagine that also the databases will show in the benchmarking analysis that 2020 was a year that was different than the years before. So as such, I think the answer is yes, at least depending on the concrete circumstances.
Yeah, I agree with you. Thank you, Gerard. So I will finally leave the floor to Seema.
Hi, everyone. My apologies. I really don't know what happened here, but we'll start now. So like I was telling you all, and like, you know, everyone knows, we've seen a spate of rulings in India. We've seen like about 7,500 rulings ever since the law was introduced in 2001. We've seen 204 rulings on Intra Group Services alone. And I'm still talking about reported rulings. There might be some unreported ones. And like you'll have heard from everyone else on the panel earlier, it's really, you know, the case of the revenue rests on a couple of pillars. I'll take you through them, and then I'll take you through some of the interesting cases we've dealt with. So, you know, there is a need versus benefit test that the revenue insists upon. So one is, did the taxpayer need to avail the service? And the second leg of that question is, did the taxpayer benefit from the service? Now, when it comes to the need of the service, the jurisprudence is more or less getting settled to say that it is not for the tax office to question the commercial wisdom of the taxpayer. It is the taxpayer's right to choose whether he wants to avail a service or not. So the commercial expediency is kind of, you know, it comes up, but it's kind of whittling down. However, the benefit is something that is consistently questioned. The fact, the demonstration by the taxpayer that the services have actually been rendered, that is critical to the overall defense of the arm's length nature of intergroup services. So there needs to be a demonstration of the fact that services have been rendered, the documentation around it, the cost allocations around it are something that are challenged, the markup. So these are really, you know, the pillars. And then there are some legal peculiarities around, you know, who should the tested party be? Can the transaction be aggregated with the overall net margin of the taxpayer? These are the other smaller controversies that we see around it. So that's really, you know, the background of the transfer pricing controversy that we've seen in India. I'll take you through some of the interesting case laws we have dealt with. So this is a case of CLSA India. It was an equity broking company, and it had associated enterprises in Singapore and Hong Kong. They were providing support services, and these were both back office and business support services. Now, equity broking by its very nature is a high margin company service because the overheads are really low. So our company was earning a margin of 26%. As opposed to it, the comparables were earning 10%. Now, the documentation that was provided initially by the taxpayer demonstrated that because this margin that the taxpayer has earned is at arm's length, the argument was that all the underlying transactions, including the intergroup services, are at arm's length. However, during the course of audit, the taxpayer did support it. So the taxpayer did give a report from a Big Four, which gave the cost and the basis of allocation of the cost. The markup was supported by a review from another Big Four. So all of the documentation was in record. Now the tax office went ahead and did something very dramatic, really, for lack of a better word here. What they did is they went through all the services in details, and the tax officer, without giving any basis, just said that it looks like 10,000 hours have been spent for rendering these services. And I'm going to estimate the rate per hour to be 3,000 rupees, which is like 40 euros maybe, or even lesser. And So this is, what the taxpayer came up and he said that this is what, according to me, this 30 million rupees is what should be the value of your services. But the taxpayer's payment against this was 1,467 million rupees. The tax office just went ahead and made an addition for the balance. And these were really the grounds of the tax office for discarding the taxpayer's analysis. May I have the next slide, please? Thank you. So this is what the tax office went on to say. It said that the taxpayer has failed to establish that the services were inextricably linked to the other services, meaning this is why the overall TNMM should not be accepted. Then again, there was another ridiculous argument which said that, the comparables may not have the same level of service, but even if they had the same level of service, if anything, their margin would have been lower. But be that as it may, then it also said that the services rendered by the taxpayer, the AEs are general. There is no evidence to substantiate the costs. Now, again, being able to substantiate the costs is really not the test. The test is what the services is rendered. So again, these are factual errors in the observation of the tax office. Then the tax office went on to say that some of these expenses that you have, some of these services that you have received are by virtue of, you being a part of the group company, and a third party would have probably not paid for these services. Then it went on to say management and legal support are in the nature of shareholder activities. And then it went on to say that the taxpayer has failed to prove the details of number of hours and per hour cost of the services. Now, some of these could have been interesting, but in light of what the tax office did next, a lot of these arguments went out of the window. May I have the next slide, please? Thank you. So what the tax officer, like I told you all, what the tax officer did was he just did something very ad hoc. He just said, 10,000 hours, 3,000 rupees per hour without giving any basis. Now, the law very clearly provides that even if it is the taxpayer or the tax officer, whoever is determining the arm's length price, they still need to follow the methodology which is set out in the law. And because the tax officer did not follow the methodology, his determination of the arm's length price was held to be incorrect by the tribunal. And the tribunal went on to say that the method in which the tax office has applied the cap is not supported with anything. It went on to say that there is no reason to reject the taxpayer's TNMM. It went on to also say that it relied on the supporting documentation, which kind of brings out the importance of putting supplementary documentation out there as backup. And then lastly, when it came to the benefit test, it did hold, which is consistent with what we have seen in even High Court rulings, that the tax office cannot question the commercial wisdom of the taxpayer to avail the IGS. So this is one of the interesting ones we saw where, apart from challenging the taxpayer, it just went on to a very, very arbitrary estimation of what the arm's length price should be, and which is where the tax officer's case really weakened. Will you go to the next one, please? Thank you. Now, this next case study that I'll take you all through is in the case of 3M, where again, the benefit test was questioned. Here, what the tax office just did is it blanket said that no benefit has been received by 3M, and that is why we are determining the arm's length price to be nil. It also said, it also did an analysis of the profit margin, and it said that payment of the management support fees has led to a reduction in the margin of the taxpayer, which also kind of evidences that there was no need for the services. So what the 3M did during the course of appeal is that it did, kind of put on record details of the services that were rendered. It gave some categorization of the services. It said that, we've given administrative and business support services, marketing and sales support. We've received technical services, so on. May I have the next slide, please? So what happens is, after the audit, it can either go to the commissioner or we have an alternate dispute resolution. Now, this particular case went to the commissioner appeals before it came to the tribunal, where the tribunal allowed some of the services, and for some of the services, the commissioner was not very convinced and he disallowed it. The matter came into the tribunal, where the tribunal held that, again, the same thing, the commercial expediency of the services cannot be questioned by the tax office. However, the taxpayer needs to conclusively demonstrate that the services was rendered, and this matter was restored to the tax officer for examining proof of tax services rendered. There was one more argument that the taxpayer had taken, which was that this was not questioned by the tax office in the earlier years. However, the tribunal did hold that res judicata is not applicable, and if a transaction has not been questioned in the earlier years, it does not mean it cannot be questioned in the current year. So it's one thing to draw precedence and say that you accepted it in the earlier year, in which case it becomes precedent. But the fact that you did not question it does not tantamount to acceptance of the arm's length price in the past years. So that was 3M. Sorry, does anyone have anything? Maybe go to the next slide, please. Thank you. Now, I'll just take you all through. Do we have time, Aurelio?
Actually, let's say we are running out of time. So I was wondering if we want to go directly to the conclusion and skip the third case, so we can leave some room also to Camille to make some comments.
Yeah, sure, please. We'll just leave this one here. So these were, these are the broad tests applied by the tax office, which I've already spoken about in the beginning. So that's really on the case laws front.
Okay.
And I'm happy to take any questions.
Thank you very much, Sima. I don't know if Camille want to make any comment.
I'll just make a quick comment on the case law you have presented, Sima. So you see that the tax authorities sometimes, they challenge all the use of the CUP methods, all the use of the TNMM. And well, normally the CUP and the cost method, the cost-based TNMM are in fact the most appropriate methods to determine arm's length transfer pricing for intra-group services. But for the CUP method, you always need to make sure that you have good internal or external comparables. And actually in practice, it might be more complicated. That is why you have many taxpayers that are using the TNMM. And sometimes that's why the tax administrations, they challenge the use of the TNMM instead of the CUP. And I will give the floor to questions because we're running out of time.
Sure, thank you.
Thank you.
Okay, let me see if we wait a second for questions in the chat. It's not immediately as raising the hand, so it could take a while. Otherwise, let's say we can close here the session, unless there are also other comments from the panelists. We are perfectly on time. Okay.
Aurelio, just one thing. I think there is a question in the question and replies section.
Okay.
So not in the chat, but in...
Yeah, but I think it's related to the previous panel on COVID.
Oh, yes.
Anyway, we can take it as a last question, and then we can close the session. So, Gerard, I don't know if you are still here. So, considering that the comparable data for 2020 are not available yet, what would be the most appropriate approach to complete the 2020 benchmark analysis on the TP documentation? I imagine that due to the pandemic, the test party return will most likely be on low side and maybe outside the airline range. So this is a very hot topic because this is the question that really everybody are asking. So Gerard, I think you have already answered to this question hundreds of times. So I leave you.
If I had the one-size-fits-all perfect technical answer then to that question, then I wouldn't give it away for free, I think. But I think it's not as simple as that. I mean, as I said, I mean there's only limited data available also in the public sphere as to what has happened in 2020, and therefore, in my view, it will not be feasible to simply rely on I do a benchmarking analysis and then I do certain comparability adjustments, and that leads to an in itself technically really satisfying solution. I mean, what one could do is take a benchmarking set, and then, as I said, I mean, I think despite the OECD having concerns using data from past crises, I think it is something that may be done if the situation was comparable in the specific facts and circumstances of a case. I think the second thing that one may want to look at is really the question as to, well, how has the pandemic really influenced the relationship between the parties and who should bear these risks? And I mean, there may be, or the risks that have been materialized. And I think there may be situations where one may really come to the conclusion, yeah, there is no difference, or the COVID-19 has not led to a specific to a specific risk materialization that is not being dealt with in the contract. I think also what one could do, and that we have done now for 2020 a number of times already, is doing certain financial simulations to see, well, okay, if your company has been shut down for a while and you come to the conclusion that, well, the actual effect of having the company shut down is something that the local company needs to bear, but effects that relate to the general market demand and so on need to be borne by the other party, then there may be possibilities with financial simulations to come to adjustments of a benchmarking analysis. But as I said, I think none of these approaches by itself will lead to a range of profitabilities where you say, yeah, this is fully reliable and fully convincing. Therefore, I think looking at several things is really important.
Thank you very much, Gerard. I think that, let's say, we have to stop here.